Okay, welcome back everyone. Sorry about that. We seem to have a few technical issues and I was talking for 10 minutes and nobody could hear me apparently. Right. Can't even remember what I was talking about. Oh, yeah, questions from yesterday, and we were discussing stochastics and, well, mostly stochastics. I was just saying that I don't personally like stochastics or use stochastics, but it doesn't make me right and anyone else wrong. That's just, you know, everyone has 3 or 4 indicators that they like to use, and that is not one of mine. So that's where I stand on that issue. While we wait for the webinar to talk, can you explain what this means in the IC broker talks fixed income report, please? RX called. Okay, RX is simply the being asked what on the fixed income report what RX called -24 means. RX is a Bloomberg code for bunds. Which you probably wouldn't have known otherwise. Don't ask me why it's RX, it just is. And so RX called -24 basically meant that the bund was called to open 24 ticks lower from the cash close yesterday. And that's what that means. So yeah, sorry, RX is bunds. It's just a code for bunds. It's a Bloomberg code. Bloomberg have some very, very odd codes. It's just something that you learn to pick up over time. So yeah, that's the answer to that one. Okay, any other questions from yesterday or any other questions in general before we sort of move on to today? No? Everybody happy? Okay, all right. Those of you in the room and elsewhere, you can now see on the, I've got the, let me just move that out of the way. We have, gosh, where can I put that? This is the Bund market profile for today, and I want to just run through the market metrics from yesterday and what observations we can take in general to see whether or not we could have predicted anything that has happened today or in fact is going to happen further on. So if you have a look at this chart here, this is the Brexit day. This is last Friday, the 24th, where we had a huge move down. As you can see, we opened up here. We had an attempt higher, and then, as you can see, fell a long, long way down and closed at the bottom. The following day, we gapped higher and rallied up. We then had an inside day on Tuesday. On Wednesday, i.e. yesterday, we broke the inside day, but we then closed back within it again. So we're going to just go through our market metrics for this day here. If I just take these lines off for you. So, market metrics, you might want to write these down in your notebooks because I haven't got a chart to write them down for you. So, but this is the sort of thing you should be writing down every day. So when you came in this morning, the plan, as part of your plan, you'd be writing down your market metrics. So the first thing you're going to write down would have been that open, which was 166.75. 166.75 was yesterday's open. The high of the day was 167.12. The low of the day was 166.64. And the close of the day was 166.68. So the first thing we're going to note is the size of the range. So from 64 up to 12, that's 48 ticks, which is pretty standard, I would say, for bunds. Bunds, you're looking for 40 to 50 ticks at the moment as an average sort of day. Obviously, this trend day was a huge exception given the major news that we had out. But 40 to 50 ticks is fairly standard for bunds. And even before we do anything else, there's a couple of things to note that we can just take from that. Firstly, the close is below the open. And secondly, the close is pretty close to the low of the day, which indicates what? Just that very basic news. It certainly indicates, I don't know, bearishness or just weak. I would say it indicates weakness for sure. There's an indication of weakness. So that's just from the open, high, low, close. Now if we look at, next thing to look at is the initial balance high and low. So the initial balance high was 166.87 and the initial balance low was 166.69. So that's an 18 tick opening range. And from there we extended down 1, 2, 3, 4, 5 ticks, and then we extended up for the rest of the range. We then want to look at the value area high and low. So for time, just using time alone, value area high for time was 167.01, and the value area for time was 166.75. But for volume, it was actually a little bit lower. It was skewed slightly lower on the volume. So we had 97 as a high and 71 as the low.
Do you kind of infer something if the value areas of time and volume are slightly ever so slightly?
I always give more emphasis to the volume than to the time. It's an indication that although for me, if the volume is lower or higher, significantly lower or higher than the time value area, it's an indication that the market is sort of painting a bit of a false picture, if you like. It's spending quite a bit of time at the higher end, but it's not actually facilitating trade. So there's no trade actually getting facilitated up there. Actually, the reality is, so it's another indicator alongside the fact that we close below our open and we close towards our low. It's another hint that the market perhaps isn't as strong as it looks. Because on the surface, this day should be quite bullish. We've had 2 inside days and we broke them on this day. So in theory, the market should be going up. You're saying to yourself, okay, it's managed to break these inside days. That's quite strong and bullish. Perhaps we're going back up. But actually, the internals of this day are indicating something different. Being asked if there's a difference in writing it down or putting a reference line on the chart, having trouble understanding the difference. I personally will put reference lines in areas that I think are very important. There's no difference between writing it down and having a reference line. What I tend to do is write down a lot of levels and then put in the key levels as a reference line. So if, for example, let's take that high from there, that inside daybreak, I would put a reference line on there. But otherwise, it's just personal preference having it annotated. But I do think the trouble with reference lines is that after a few days, you forget why the hell did you click on that in the first place? Why is that line there? You can't remember. If you've written it down and put next to it, well, this was the value area high from whatever day it might have been, then that's fine. You can just see that straight away. But sometimes reference lines, sometimes they're negated and you forget to take them off. So it's always difficult. I find that better to write them down personally and then put the important ones on with a reference line. Okay, that was value area. So value area high, value area low. So midpoint and volume point of control, both at the same place. 166.88 for the midpoint and the volume point of control. Basically, therefore, that's a more indicative of balance than anything positive or negative. The time point of control is a little higher, up at 93. And you can see actually there's very little difference in volume between 93s and 88s. What can we say about the high? It's a weak high. It is a weak high. Okay, so it's a weak high. And is there a buying tail? No, there isn't. Okay, but we did close down here. So this is a bit of an anomaly. I'm going to put a line in there because of that. So bear in mind, at some stage, when it comes back up to this high, not necessarily expecting it to hold. So what else can we take? Is there anything else you want to take from this day that we're going to look at? Any other information you want to take from it or interpret from it, or anyone got an opinion on it?
Probably been a break upwards.
Say again?
Probably been a break upwards today.
Okay. Why do you say that?
Because it holds a low of the I don't know what day is that.
Well, hold on, before you go on to today, let's just look at it's this day I'm really focusing on. So why? What else can you get from this day, apart from what we've just said?
You have the previous day's high and today's what's called the T-port being at a similar level.
Yes. Okay.
So it's like a resistance support level.
Yes, good. So that's this area here, this the 90, 94, 93s here. So yeah, you got these two highs here, one at 90, one at 92, and we spent a lot of time just at 93. And you can actually see as well, as I said, the volume is pretty good. It's the second highest TPO that we've got. What else? Anything else?
Oh, its value area is completely above previous day's value area.
That's good. So yeah, so basically the market decided yesterday that the area where it wanted to do business did not coincide with the previous day's value area. So where 70% of the trade took place the previous day, it all took place much higher. So what do you think this is? What do you think people are doing here? If you look at this in context, so what is people's predominant position on this day here?
Short.
Short. Okay, what's going on in these 2 days here?
Profit taking.
Goes in the shorts.
Some, but also I would say there is balance
Also-
going on. There are people selling and people buying with nothing decisive happening. We have an inside day on the Monday. We have an inside day of the inside day on the Tuesday. So what's happening here?
Broken through the inside.
So we broke, but this day, with the value area being above these 2 days, this is short covering. This day is there are buyers, mixed buyers and sellers, okay, coming to an agreement on price. Likewise here, it's all indecisive. If you were short, let's say you sold it on this day here after an hour, and you're short in here somewhere, you wouldn't have traded these 2 days. There's no need to get out. You're not wrong, you're not right. You're looking for a continuation. But on this day here, this looks more like profit taking. This is people taking a bit of profit. And obviously, there are still people getting short because the market is still, look where it's come from, all the way up here. So there are people short. But what happened is a lot of those shorts got covered yesterday. And because of that, there were less shorts in the market. So what happened this morning?
Gap down again.
So it didn't gap down.
Went up.
Okay, so it opened here pretty much unchanged from the previous day's close. Okay, it closed at 68, it opened at 70. It tried to trade higher. Okay, it tried to trade up to the volume point of control in the midpoint. So the first hour went from 70s up to 85. So 15 ticks opening range, initial balance, sorry. And if you've been looking at this, most of these opening balances are 12 to 20 ticks, there or thereabouts, on a normal day. Monday was not a normal day. Friday was not a normal day, and Monday was not a normal day. But the rest of the time, if you look back, in general, on a normal bog standard day, in the boon, you're looking at 12 to 20 tick opening ranges, something like that. So we attempted to trade higher in the pre-cash market, the Ks and the Ls. And then the cash opened and we traded down. So because there are too many shorts in the market here for the market to go lower, and in fact a lot of them get squeezed out on this day here, and then today people will be resetting shorts, and we sold off quite aggressively. But what stopped us? What saved us? What's the important level? So it's okay, not just this level here, these 43s. A, it's the VPOC from Tuesday. B, it's the breakout area from Monday. There's two really good reasons for, this area is clearly important. You can see that. And the market came all the way down and it broke it by a tick, and it's rallied since all the way back up. It's rallied all the way back up to 70. It's rallied 27 ticks. Okay, and it's held, but that's so predictable. If you're looking for a support level, this was always going to be your first support level. First of all, it's a breakout level. Secondly, it did all that volume there. So supposing we come through, where would you be thinking about your next area being?
The low of 28.
This one here, yeah? Okay. I mean, I would also be watching. I wouldn't necessarily trade there until I'd watched it. Sorry, just bear with me while I just lose some lines. The other area is this area here, and I'll be watching this bottom of value area around here. Just keeping an eye on it. It's where the volume starts to pick up on this day, and it's just where it sort of runs out of steam a bit on this day. Wouldn't necessarily be putting a trade on there, but I'd certainly be watching it. Then you're right, these 27s are important, and then coming back down, you've got this area here, sort of 12, no it's not 12, sorry, 13, 15 area. Keeping an eye on those. You've then got that close at 02. And if we start rebuilding here, what are we going to do? What do you think is likely to happen?
Today,
What? Yeah,
it's going to be an inside day.
it's going to be a what? Sorry.
Well, not an ins, but a very balanced day today.
Could be a balanced day. Yeah, it looks like it could be balanced. If we start pushing up, where's our first area of resistance?
Again, it's a feeling from yesterday.
Yep. So 88, just above here, and then we're back to this 93 zone. That Richard pointed out, so the time point of control and these sort of old highs. And then above that, we've obviously got that weak high as our sort of target to take out. So this is, when you get to a situation like this, sometimes it's a good idea to put all these together, because this is basically post-Brexit. All of this is the work that's been done post-Brexit. So if I just merge all of these together, what we're going to end up with is one giant profile. So since Brexit, sorry, just being asked a question. Just to be clear, do you put more weight on the volume value area high value over the value area high and value area low? Personally, I put more emphasis on the volume value area high and value area low. That's my, yeah, I always pay more attention to volume than I do to time, is the answer. So this is a post-Brexit profile. And you can see obviously got an extremely high, long tail on the upside. But basically, we've been in balance between around about 167.00-ish down to 166.20-ish, something like that. And frankly, we are actually trading pretty much in the middle. And you can see since Brexit, the actual VPOC is 70, the TPOC is 68, and that's roughly where we're trading. We're just trading either side of that. We're pretty indecisive. If you look at it like this, you know, it's hard. You could toss a coin, frankly, as to which way we're going to go, just purely off the back of this at the moment. It's a little unbalanced. It certainly looks like it should be doing a bit more work down here to fill the profile out. And that might be what happens. We might come back down again and test this area. But it looks very different to how it did when it was all separate. Do you see that?
Yep.
Yeah. So it's important, and when you know, I think I saw someone ask a question yesterday. I was watching quickly on the stream. Someone sort of said, how do you decide where to do a sort of cumulative chart to sort of have a look at what's going on, what area? Well, this is an obvious example. You know, we had a huge new piece of information come out on Friday morning, i.e. Brexit, and so you want to look at the trading since then. Because whatever happened before is irrelevant. People were making decisions based on something that is no longer a fact. So you want to know what are people's decisions based on what's going on now. So when you look at a chart sometimes, you might go to yourself, well, what's a major event? Well, okay, there was a non-farm payrolls out here. So people had new information. So everyone who made the decision before that doesn't matter because they didn't have all the information. What I want to know is what's their decisions now or since that information. So, or before a rate cut and after a rate cut or rate hike, whatever it might be. So it's a good exercise to sort of make sure that you know what the events are and when they occurred. And here we are basically trading absolute mid-range. I mean, yes, the mathematical midpoint is way up here, but that's because it's so skewed. So skewed because of this long tail from Monday. But the reality is that we've basically spent most of our time trading in this 80-tick range, and we are bang smack in the middle of that. Any questions on that? let's just remove all that. So back to here, and here we are. We know we're trading mid-range. So yes, on a small micro scale, you can sort of look for this to be building, and perhaps ultimately come back up and test this high. But for now, you can see that it's difficult to make a case just on this as to whether or not we're going to dramatically go up or dramatically go down. It looks more like we're going to range for a while, and then perhaps once we finish ranging, then we'll have a breakout. Maybe we'll get new news. I don't know, but something might happen to change that. But at the moment, we're just stuck. Any questions? Okay. Let's just have a look at the Euro stocks, see if I can find it. Sorry, I've lost the toolbar. I'm just looking for it. Bear with me. Where the hell it's gone? You can't see a toolbar hiding anywhere, Johnny, can you?
Market delta.
Yeah.
I'm sad, I don't even know what the toolbar looks like for market delta.
Okay, no problem. Sorry, bear with me. Where has it gone?
You can try and enable all, and then
Yeah.
disable the ones you don't want.
Yeah, it doesn't appear. Okay, never mind. I'll find the chart. Hang on, let's just find a chart. Hold on. Open chart. It's not playing games, is it?
So weird. Why is his name George?
Oh,
What's his real name?
it's a Hungarian name. Something Schwartz, I think.
Georgie. Georgie. One of those weird names.
His last name used to be Schwartz.
Schwartz.
Okay. I don't think I'm going to be able to do that. Sorry, I seem to have lost the
George. Oh, I see.
lost the toolbar.
He was born in 1930. How old is he? 95 years old.
How strange. No, not going to play ball. Okay, I'll deal with that later. All right.
On the left.
So again.
I just saw a toolbar pop up.
Oh, did you?
Yeah, on the left.
That was a good spot. I don't know what I clicked though.
It's behind this left Bunde M. It's behind, it's near this somewhere. If you click on behind it,
That's not what I need. That's not the right one. Never mind. I'll come back to it. I'll play with it when we take a break.
there it is.
Yeah, it's behind the white
It's just on the
graph.
edge. You see it?
What,
It's
this?
gone down, it's gone.
Every time I look away, so there it's like,
You click on the main window.
yeah.
Pop up like. No, it's
Be-
Probably behind all of you.
It's behind you.
Oh, wait, what
It's
do you mean?
behind here somewhere. Okay, I'll play with it. Don't worry. I'll find it. All right. I'll have a mess around. You see, it comes out over here.
I need to go back to the gym now.
All right, I'll do it this way instead then. It's all right. Don't worry about it. I'll play, but it's not really working.
I was going to say you could just change your main display to
No,
that one.
I'll leave it on this for now. It's fine. Okay.
Yeah. Okay.
Okay, guys. So there are several different types of trade types that you can look for, and different days where you can make some money. Options expiry is one of those. It occurs on the third Friday of every month, so 12 times a year. You might hear on TV, when you watch TV, people talk about double witching, triple witching, etc., which involves the expiry of futures and options. So the third Friday of every month, options on stock indices futures expire, i.e. FTSE futures, DAX futures, S&P futures, Eurostoxx futures. In some of those months, individual stock options, i.e. you could say Microsoft options, or sometimes the FTSE futures, they also expire. Hence you get the term triple or quadruple witching. And what it means is that we expect a period of relatively high volatility. So during the course of the day, various different products expire at different times. And in this case, the FTSE is at 10:15, the Eurostoxx is at 11, the DAX is at 12, and the S&P is at 2:30. So how do you think they decide the price for the options expiry? What happens? Any ideas?
What do you mean?
Well, how do they decide? I mean, what happens? Is it just that whatever price is trading at the time, 10:15, that's it? We just take that, or is there something different goes on? Closing price, right? Anyone else got any other thoughts?
What if you hold it to maturity? You don't. There's no price. You exchange the goods, the product. Like you deliver whatever the underlying is.
But at what price do you deliver that?
Oh, strike.
But what's it offset against? What you've got to still have offset against the market price to decide whether or not you're in the money or out of the money.
Yeah, obviously.
So what happens? Okay, well I'll tell you. Basically, all these products have an auction, and it varies from contract to contract and product to product. And if you remember back to the distant days when I got you looking at contract specs, it's all part of that. So FTSE has a 5-minute trading window from 10:10 to 10:15, in which they take the weighted average. And the reason they do this, the reason why they take weighted averages usually, is because it's open to manipulation. Okay, and if something is open to manipulation, it probably will. Say again.
Exactly. Like, how is that allowed? Like,
How is that allowed? How is insider trading allowed? How is anything else allowed?
no, but when it comes to auctioning the close price, for
Yes.
the next rollover,
Yes,
market makers can simply just get the better price by bidding so much higher.
they can, but there are other people who are trying to push the market down as well. There are people trying to buy the market up and people trying to sell the market down to suit their position. And that's what, but it's much harder to manipulate a market over a sustained period of time. So for 5 minutes, that's quite difficult. I mean, you've got to have a lot of money behind you. And not only that, the exchanges and the authorities are alert to this sort of thing, and they know that they're looking for suspicious behaviour. So you have these trading auctions that take place to decide what price is expiry is going to be on. And in each case, there are expected pattern plays in the market for each indices, and these pattern plays are basically expected, but they're not guaranteed. And what we're looking for basically is if the market is manipulated, so if you get a move in a market, let's take FTSE for the sake of argument, okay, and you see FTSE into the expiry rally 20, 30, 40 ticks, what's actually going on? What do you think is going on? Do you think that all of a sudden the UK economy is worth a 40 tick rally in FTSE and therefore is it, or do you think that once this short term effect passes, the market should revert back to where it was?
Yeah.
But
And that's what you would expect. This is a short term move based on an options expiry, and once complete you would expect the market to return where it came from.
How many times does that actually happen?
How do you mean, how many times?
More or less. Like sometimes it does actually. There's a really big month then, and it
Yes.
does actually follow up like you expect.
Yes.
But I guess that.
I would say, I mean, well, it's difficult to say. I mean, options expiry, the problem with options expiry is that we don't know which companies actually have to exercise options or how many they have to exercise and whether or not they are going to exercise. But what we're looking at, well, the way we use it is that we know it's an artificial settlement price. It's just an artificial arbitrary time randomly put in, and therefore we are alert to the fact that if you get a big move in a market leading up to that, it should reverse partially at least.
Right.
How often does it happen? Well, to one extent or another, about 70% of the time, but it varies, and sometimes it'll only pull back 10, 20%, and sometimes it'll pull back the whole way. Sometimes it won't pull back at all. The point is that you're aware that something should happen, and therefore you can trade it accordingly. That's what you've got to keep your eyes open for. It's an artificial constraint put on the market, and you have to take advantage of it.
Do the algorithms trade around that?
Yes, they do. Yes, yeah. Okay, month end. Similar thing. We've got it this month. We've got it today as well. Applies to both indices and bonds. Obviously, it takes place on the last trading day of the month. So, yeah, it has to be a trading day. We have government bonds. We get what are called index extensions. So many people, they don't just go out and buy a gilt. They buy an index, a selection of government bonds. And the rules on the bonds, they have strict rules as to which bonds they can hold. So let's say you hold a portfolio of bonds, and the eligible bonds have a time to expiry of 8 to 10 years. Okay, anything within 8 to 10 years you can hold in your bond portfolio. Well, as we move to expiry, we suddenly slip forward 3 months, and therefore something that did have 8 years to run has now got 7 years, 7 years and 9 months to run, and therefore is no longer eligible and drops out of the portfolio. At the same time, they then have to go and buy bonds that suddenly become eligible to make up the numbers. So it involves buying bonds, and it involves buying 10-year bonds predominantly, because that's where the index is, that's where the bulk of the bond portfolios are. As a result of this, we expect to see demand for government bonds as we enter the closing price for month end. And the closing price is done when, do you think? Where do you think they take the closing price for bonds?
5 minute average.
Last 5 minutes of what?
Closing price average.
Yeah, closing of what?
Closing of future contracts average.
Okay. Okay, I know why you're saying that, but we are dealing here. So what's the underlying product? We're dealing with what?
Government bonds.
Actual government bond. Actual bonds.
Cash bonds. So the people who are trading their portfolios, you think they hold actual cash bonds in those portfolios or futures?
Both.
Both, but predominantly cash. Okay, they might hedge with futures, but they basically hold cash bonds in their portfolio. And therefore, what we're looking at is the closing price of the cash market. So in the case of bonds, it's 415. So they take the closing price. So at 4.15, that is the price that is used for the rollover. And this obviously creates demand. They have to physically go and buy the bond, and it causes the price to increase as we close in on 4.15. And we'll have a look at some charts in a minute and have a look at that, how that looks. So for example, I mean, this is taken from a long time ago, but there are, you know, this is all to do with pensions and portfolio analysis, and these guys are big. I mean, this is not, we're not talking about someone with, you know, 50 million quid here. We're talking about some serious money, and there's a lot of bonds that have to be bought. I'm not going to bother going through all this, but I'll just send it out to you tonight. But have a read through all this, and it shows how and why we get this rebalancing going on. Usually we get an update. So, for example, Barclays. This would be an example of their updated month-end index extensions, and this is in years. So their treasury portfolio extends by 0.06 of a year. Their European portfolio extends by 0.10 of a year, and so on for the UK products and for the Japanese products. So most fixed income indices are defined by a strict set of rules that determine which securities are included and which securities are excluded. Okay, since fixed income instruments are dynamic, they have a set maturity and coupon rate, and rebalancing of the index needs to be done periodically as new instruments are introduced and old ones mature. To simplify security selection, securities are usually categorized by type of issue, issuer, and issue size. So an index then defines which security type is included and also the minimum issue size. So government index with a minimum size of greater than $500 million, for example. And as I said, I think probably best I leave this for you guys to all read through yourselves, but be aware that all the details are in here. We also get month-end fixing for Forex. Okay, it's the same for all products. So obviously the FX market is huge. And again, we get this fixing, though. The fixing done in Europe is done at 4 p.m. So 4 p.m. UK time is when we get fixing done in the Forex. And again, it's done at that time with a 2-minute window of auction. So 4 o'clock. And again, you get extreme volatility. It used to be, I mean, if we go back 3 or 4 years, it used to be that this was so heavily manipulated. You could get a 200 pip move in the euro easily as we come into options expiry. And luckily, a lot of those guys are in jail now. They all got prosecuted, but it went on for years and years and years. Huge moves. Even nowadays, you still get 40, 50 pips quite often. But anything that is open to manipulation, where you have an artificial close. Say again? It will be manipulated because there's money to be made. Absolutely. Same in indices. So portfolio managers are attempting to lock in profits and limit losses on the last day of the trading month. It's an account balancing exercise. And in order to keep their exposure to a minimum, they do this as near to the market close as possible, therefore creating heavy volatility in the last few minutes of the trading day. And as most funds are long only, obviously not all funds by any means, but the vast majority of funds are long only, what we're looking for is selling into the close. And I will show you some charts in a minute to give an idea of how the volume just spikes at the end. I mean, a phenomenal amount of volume gets done relative to the rest of the day.
Why sell? Shouldn't we buy in front of them?
Well, no, they're selling. Why would you buy in front of them? Most funds are long only. That means their position is long to start with. So we're expecting them to sell. Most portfolio managers, what they're trying to do is they need to post profits and show profits for each month. I mean, it's become a very short-term gain. Any questions on that? So just reading a question here. How would I have traded the stocks for OPEX on June 17, which is also a rollover? Notice that the June contracts have mostly moved over to front month of September and flows were light, less than they should have been. I traded at 10.43 to 11, we got trapped first time this happened. Yeah, it's always difficult when you've got rollover at the same time. I would definitely not be trading the back month, i.e. June. I would always trade the front month, September, on the assumption that whatever happens to the back month, the one that's been affected by the OPEX, is still going to have an effect on the front month, i.e. September, would be my answer to that one. So if portfolio managers are selling on the last day of the month, what's likely to happen after that?
Buy at the beginning of the month.
Buy at the beginning of the month, yes. Okay, very good. So not only that, why else would they be buying at the beginning of the month? What else happens at the beginning of the month?
Whatever is sold at the beginning of the month, you're gonna buy it back at the
Okay, that's true, but what else happens at the beginning of a month? I don't know if you guys do any of you guys have a savings plan or anything like that? You're probably all a bit too young. So what do you do? What do people generally speak? What happens on the first of the month for most people anyhow?
Reinvest the savings.
Well, they get paid is the first thing. So they get paid, which is useful.
So they want to spend the money.
Not only that, yeah, they generally speaking might have a savings plan, and they might be investing £50 a month in a PEP or £100 a month in a tracker or something like that. Well, the vast majority of all that money goes in at the beginning of the month. Most people don't sort of get paid on the 16th of a month and then put money to work on the 17th. They get paid at the beginning of a month, and they put the money, so their direct debit comes out of their account and it goes straight into a tracker fund, and they buy the market. Yes.
So, when you see they get paid at the beginning of the month, do you mean that they get paid as salary or new investors?
Sorry, no, what I mean is that, you know, most people's salary is paid on the first of a month. The vast majority
So
of
it's
people.
like retail, individual.
It's retail, but it's big money. You multiply everyone's mum and dad sticking 50 quid into a fund, and it's a lot of money at the end of the day. It adds up considerably. So on an individual basis, most people don't put very much money away, but if you add it all together, it adds up. And it's just another impetus for the first of the month to move the market higher. So having sold their portfolio last night, they need to buy it back the next day. In addition, monthly contributions to PEPs, ISAs, 401ks, etc. frequently go in on the first of the month and are generally invested in things like tracker funds or long-only funds.
Do they? I forgot my question. Sorry.
Say again?
I forgot about my question.
You've got your question. Well, when you remember it, feel free. Are the movements more aggressive at the end of the quarters? Sometimes, Wayne. Certainly, it varies. I would say the busiest quarter is usually the first and the third quarter. Second quarter, i.e. today, less so, particularly today, given that we're very close to July 4th holiday and the US people are pretty much done for the week.
I remember you said having sold the portfolios last night, you need to buy them back the next day.
Yes.
Can they learn from this lesson to not just sell the portfolio?
But they have to, okay, legally, if they're going to, one of the things, the way investment management works these days is that they have to be able to show, they market to market, and they need to show that they've outperformed their peers. Yeah. And this is the way they do it. They get rid of, and also there are all sorts of tax reasons which are way over my head for doing all these things. Hence, we get these movements. The one thing about the first of the month, it leads to inflated demand, and most participants try to buy the open in order to avoid exposure to a directional price move. The problem is that if you've sold on the last day of the month, you then come in, the market opens and it gaps up 50 ticks. You've suddenly lost that 50 ticks effectively against your peers. So you need to get in very, very quickly on the open, and that's why you get this move. And again, do you think this happens at 7 a.m. when the futures open, or at 8 a.m. when the cash opens? And it's cash, so we're dealing with cash here. Very important to understand where your cash market opens and where your futures market opens. So let's just have a look at a couple of examples of in the past. Down the bottom here, this is volume. Okay, so this is volume, and this is I think it's a 5-minute chart. So buying, generally speaking, comes in round about 3 to 3:30 in the afternoon, leading up to 4:15, and you can see that on this particular time, 139.00 was a low at 3 o'clock, and it rallied 50 ticks up to 55 for the actual close. You get a initial surge of buying, a consolidation, and then a late surge of buying in the last 15-20 minutes. Also worth noting how the volume spikes when the buying starts, and then it spikes again at 4:15 and then tails off. This is an example of FTSE close. Now this is really important. Look at the volume. This is the volume all day long. All this volume going through, and then on the cash close, look at this. So normally you're getting about 300 to 400 lots going through every minute until the cash close, when 12,000 go through in a minute. Okay, a huge spike, and the selling starts early. So it starts here around 4:10 and continues through to 4:30. And what happens after 4:30? No volume is true, but what happens to prices after 4:30? Well, what stops? Yeah, cash, but what else stops? What's been going on in the lead up to 4:30? Big red yeah, selling, exactly. Big selling going on. What happens at 4:30? Selling stops. Okay, there's no more aggressive selling going on. And then there is a retracement of some of the move. And if you really look at it, by the time we get to here at 5 o'clock, really we're trading where we were before the fun began at 10:02. We got a false move higher, big sell-off, retracement back. And basically everything gets back to exactly where it was before.
Can you just put a buy order right just before the close?
You can, but you want to do it just after the close, ideally. Yes. I mean, people do look to reverse their positions, yes. Okay, here's the S&P. So again, same thing, coming into the 9 o'clock cash close for the S&P. Look at the volume. So normally we're doing about 3,000 lots per minute. Suddenly we do 130,000 lots in a minute. Okay, that is phenomenal amount of volume. So 130,000 lots times $50, someone else can do the maths for me, but it's quite a lot of money. It adds up. And you can see we get gradual sell-off, and then a very aggressive sell-off, and then what happens? Selling runs out, we get a reversal in prices. The problem you've got, and this is where month end is tricky, you know, if you bought a little bit too early, it comes all the way down here. So it's very difficult, and if you watch the markets tonight, you'll see, you know, you watch CNBC at 9 o'clock and you'll watch that market just go, but it'll come back again within a second or two. It's very aggressive and very quick, but those volumes are amazing. You know, you're doing 3,000 or 4,000 lots a minute normally, suddenly you do 130,000 lots. That's a massive increase, a huge increase in volume that's going through. You mentioned I like to trade the S&P. Do you see the same price actions with month ends? Well, yes. Sorry. So Wayne, hopefully that answers your question. That is the S&P. Then we come to the first of the month. So here we are. I think this is the same month that we had the last. So that's your sell-off in the FTSE, and then the following day we open and we're looking for this opening drive. So we get a nice big opening drive. So the market pretty much opens on its low, and it goes higher, and it stays pretty bid right the way through till, certainly until lunchtime, until the US comes in. So through till 1 o'clock we get an initial opening drive. Prices do get repulsed, but they go in again and again and again, and then the market stays bid all the way through. Any questions on those? Just see if I can. Sorry, the other thing I wanted to point out on that is look at the volume. So look at this opening volume that goes through. Big spike in open volume. So it's actually the busiest until the close. This is a cash close over here. Until the close, that first minute bar is the busiest. So everyone piling in. It's exactly the same as everyone, all the volume here on the sell side for the close, and then on the open, all the volume going through. Okay, this is what we're looking for. All we know about all these things is that we're going to see extra volatility compared to normal, and we're going to see high volume. Now, at the very least, if you're aware of all this, you should save yourself money by not getting involved the wrong way around. You know what's expected, so you shouldn't get caught out by a surprise move. So at the very least, all you're going to do is save money because you're aware of this setup, what could happen, and you're not going to get too involved with it, and avoid the volatility and save money by doing it. As you develop and as you become better and better traders, and you've seen several months worth of this, you might decide to start getting involved. But initially, at least you're saving money. Instead of coming in and going, oh, the market's much higher today, I think I'll sell it. There's a reason why it's much higher. You're going to get run over by a bloody train if you get in the way. So don't do it. So at the very least, save money doing this, and hopefully at the best, make money by understanding what's going on and being able to jump on board.
How many seconds do you have to initiate a trade?
On the open or on the close?
Or is it both?
Not many. You've got to be quick. There are certain times when you want to buy and certain times when you want to sell, and we'll have a look at that after we've had a coffee break, and I'll go through and I'll show you some opens and closes that we can, that you could trade. Okay. Would it be worth holding a trade overnight? The answer to that is it is, but you're obviously exposing yourself hugely to risks that you may not want to take. A, it's going to cost you a lot of money because you're going to have to put up margin, and B, you're exposing yourselves to event risk, and that's probably something at the moment, for example, you probably wouldn't want to be holding things overnight given the rather febrile atmosphere around the planet and what could happen. But yes, you can. It's certainly a very valid trade. Any other questions? Okay, well, I'm going to try and repair this market delta then, and we'll take a 10-minute break, and then I'm going to discuss opens and show you some videos of open types and open trades, okay? So, bless you, quick 10-minute coffee break.